Hello everyone and welcome to this quick fire revision for Ind AS 37 provisions and contingencies. Now there are a few standards which are specifically dedicated towards specific liabilities like Ind AS 19 for employee benefits, Ind AS 12 among other things to deferred tax liabilities, Ind AS 109 among other things to financial liabilities as well. However, there are many other liabilities in the balance sheet, like for example warranties on the goods that have been sold or ongoing lawsuits which have been filed against the companies. These liabilities are not covered under the above mentioned standards. So how do they get accounted for? Well, guidance for that for liabilities in general which have not been covered under specific standard is given under Ind AS 37. It's an important tier 2 category standard which generally covers the accounting for liabilities. Now before we proceed, what is a liability? Well, liability is a present obligation that is arising out of past events for which an entity expects an outflow of resources. Too much complicated works. In simple words, let us say if you were to take a loan, you are under an obligation to repay the loan and that obligation is existing, so the loan is a liability. So sir, the words liability, provisions, a lot of times they have been used interchangeably. However, strictly speaking, provision is something where there is some uncertainty attached, not just for the standard but in general. Like for example, when I have to repay a loan, I exactly know the amount of loan to be repaid, so it can be shown as a payable or a liability. However, strictly speaking, if there is some uncertainty attached, like you have earned income during the year and you have done some self-assessment and according to you have determined how much tax is to be paid, this is uncertain because the final outcome will be dependent on assessment which is completed, and hence we create a provision over here for a payable because there is some uncertainty attached. Now for the liability to remain or for a provision to be created, it is necessary that there is a present obligation, that is an obligation should be present or existing as the case may be, and the obligation exists if the obligating event has happened. Now what do you mean by obligating event? Now the obligating event over here can arise out of legal factors or out of constructive factors. Like for example, if I am selling goods and along with the goods that I sell, I am giving a warranty for a period of 3 years. That is a legal obligation. That means if the goods turn out to be defective, I am under a legal obligation under the contract to repair it. Or the obligation can arise out of law. So for example, there is a site restoration obligation as per a particular law, in which case you have to restore the site, in which case there is a legal obligation. However, Ind AS also covers something called as a constructive obligation. Now a constructive obligation refers to an obligation which either arises out of past practices or published policies, which gives rise to expectations in the minds of the affected parties. Simply put in, maybe it is covered or not covered in the standard, but let us say something like a Diwali bonus. A Diwali bonus is something which may not be contractually agreed. However, as per past practices, we have always given a Diwali bonus and this gives rise to expectation in the minds of the affected parties, that is the employees. And hence there is a constructive obligation even if it is not legally let us say enforceable. On the other hand, you can have other items like let us say site restoration obligation or warranties, which also you have been repairing or you have been dismantling and restoring assets in the past even if you had no obligation to restore. So these are also examples of constructive obligations. Remember, Ind AS requires you to create a provision or a payable as a case may be for both legal as well as constructive obligations, whereas AS required you to create only for legal obligations. Now there is also something called as contingencies. Now contingencies can be of contingent assets or a contingent liability. Basically contingencies in the form of contingent liabilities are possible obligations. They are potential obligations or possible obligations whose outcome will be known on the occurrence of certain future events which are beyond the entity's control. So for example, over here we have been operating the factory in the past few years. However, someone is suing us for exceeding pollution beyond specific norms and hence the case is ongoing. Now we have done some pollution but we don't think that this has been beyond the norms, in which case there's a contingency. There's a possible obligation where you might need to pay the penalty. However, the outcome of that will be dependent on certain future events like the verdict of the case which are beyond the entity's control. This is an obligation, so this is a contingency which is resulting in a contingent liability. On the other hand, it is possible that you may sue someone else, and in this case you get a possible right or a possible asset whereby you get future economic benefits. Again, this is uncertain, and whether the asset exists or not depends on certain future events beyond the entity's control. Like you have sued someone, or let us say there was a loss and now you have filed an insurance claim. Now these are contingent assets. Now the most important part of this standard is to understand what is going to be the accounting for contingent liabilities as well as contingent assets. So when we look for contingent liabilities, there are two ways in which you can account for contingent liability. There are two ways for accounting for contingencies. First is accounting for contingent liabilities and then contingent assets. Now, in general, what should you do with contingent liabilities? Well, they are uncertain and the obligation is not really certain. It is not always a present obligation. It is generally a possible obligation, an obligation that may arise. And hence the gap, generally accepted accounting practice treatment, would be to just give disclosure for these contingent liabilities in the notes. So the general treatment, if there's a contingent liability and if nothing is given, is to give disclosure of this contingent liability in the notes to accounts. However, if you believe that it is probable, that is more likely than not, there is a greater than 50% chance that this liability will have to be paid, in which case the standard requires you to create a provision for this contingency. So we will create a provision on the contingent liabilities to the extent we believe it is probable. If you believe there's a more than 50% chance that a payment will have to happen, then subject to certain exceptions, you will create a provision. That is, you will pass the entry expense account debit to, let us say, a provision, and hence P&L will be debited and a provision will be created and a mere disclosure will not work. However, there is uncertainty, which means there is 50 or less than 50% chance of a payment to happen. Then rather than creating a liability, you will just give a disclosure. In certain cases, the possibility of payment is remote. There is a less than 5 or 10% chance that a payment will have to be made, in which case the standard allows you to even ignore the same. So these are the three things that you have to remember. Next, you go to the treatment for contingent asset. Now you have to take a step back in the form of conservatism and prudence, where liabilities, when they were probable, you used to record the liabilities. However, if there are contingent assets, like you have filed a case on someone and it is probable that you believe that you will win, that is a more than 50% chance. So a consistent working should have said that then you should record the asset as well. But if you record the asset, a corresponding income will also be recorded. But prudence and conservatism says that you can recognize expenses and losses as and when you expect them. However, income should be recorded as and when you actually earn them. And as a result, you should ideally wait for the time till the time it is virtually certain, that is, beyond any degree of uncertainty, that you will receive the benefit. And hence, contingent assets can be recorded only once they become certain, that is, they become virtually certain. That is more than a 90 or a 95% chance. Basically, institute may give a percentage, but virtual certainty arises from facts. It does not arise from expectations or advices, it arises from actual facts. Like for example, if there's an ongoing lawsuit and the judge gives the verdict, he gives the verdict that you have won the case and this is the penalty that the other party will have to pay you, that is virtual certainty. Though the legal judgment, actual written judgment, may take a few days, if the judge has given the verdict, that is when we say that there is virtual certainty. Or when there is an insurance claim that you have filed, let's say your advisor says that the claim will be passed, that is not virtual certainty, that is still probable. Maybe highly probable, but it is not virtual certainty. Virtual certainty arises once the insurance company confirms that you will be granted a specific amount, and this is a confirmation from formal sources. That is when virtual certainty arises. So you can recognize an asset once the receivable is virtually certain. However, if it is probable, that is a more than 50% chance, now you take a step back and you say, well, you know what, we just give a disclosure. Prudence and conservatism, if it is an asset, let us just give a disclosure. However, if it is uncertain, that is 50 or less than a 50% chance, then you don't even raise expectations in the minds of the shareholders, and hence you don't even give the disclosure, you will ignore. So you're taking a step back. So what was the accounting or the disclosure when it was remote for a liability is the case when it is uncertain for an asset. What is the accounting when it was probable is the disclosure that you give when the contingent asset is probable. Okay. Now, probable has been defined, virtual certainty has been defined, and there is a clarification given in certain cases of reimbursement assets. Like let us say you are working in a CA firm and your client has agreed to reimburse the cost that the CA firm incurs in the course of audit, the traveling, food expenses, etc. In which case, how will you do the accounting? Well, these are reimbursement assets where if you believe it is virtually certain that the reimbursement will be done, then you will recognize the expense net of the reimbursement. Like for example, you have spent 100 rupees on traveling and the firm and your client has agreed that 80% of the cost will be reimbursed, in which case you can recognize traveling expenses to the extent of 20%, that is 20 rupees, a receivable from your client to the extent of 80 rupees, and then a payment of 100. However, this is when there is a reimbursement. However, if there are insurance claims are more of indemnification contracts and not reimbursement contracts, where the loss that is suffered is the entity's loss. It is not someone else's loss. It is the entity's loss, and hence you will recognize the entire amount of loss. And then once you file the claim, you will recognize the contingent asset, and once the claim is actually approved formally by the insurance company, that is when you will recognize a receivable. Till the time it will at best be shown as a disclosure. So over here, There is also an additional aspect that we can focus on, especially in case of events occurring in the post-balance sheet period. It is possible that there is an ongoing lawsuit, and let us say someone has filed a lawsuit against you for which you believe that 10 crores will have to be paid. So you create a provision because it is probable. However, in the post-balance sheet period, there is an actual legal conclusion where the court case is concluded and the judge has said that we need to pay 15 crores, in which case this is treated as an adjusting event and you will adjust the estimate from 10 crores to, let us say, 15 crores because there is additional information for an ongoing lawsuit which is arising during the post-balance sheet period, and hence we will adjust. So this is the important facets. Various cases can come pertaining to this. The second part over here gives you additional guidance on how or what are the best practices while creating the provisions. So in terms of measurement of provision, the standard says you can measure the provisions on a best estimate basis. So if you have a range of outcomes possible, then you can calculate the value using the expected value method, that is a probability based weighted average. However, if there are just two outcomes possible, it is also possible to take the most likely value, which is likely to happen. Provisions, one needs to remember, are to be calculated and measured on a pre-tax basis, and if the effect of time is material, that is, if the payment is expected to be made at 12 or beyond 12 months, then the standard requires you to recognize the provision on the present value basis. Certain cases like dismantling, for example, there is a lot of uncertainty involved, and hence in the measurement of provisions, the standard allows you to make adjustments for certain buffer or safety margin or some other adjustment to the extent of this risk or uncertainty, and you can do this only if the question specifically tells you to do so. While you are measuring provisions, you will ignore expected gains that arise on a potential sale of the assets. However, you will consider the measurement based on the expected cost that you will have to incur. In certain extremely rare cases, in the language of the standard, it may not be you may not be able to measure the provisions, in which case, rather than measuring it wrongly, you can give a mere disclosure. Like, let us say you have manufactured a car. Now, this is the first time you have manufactured the car, so maybe you don't have any past experience to figure out how much will be the warranty claims. However, it's a standard car. You can look at industry data and figure out how much were the potential warranty claims. However, this car that you have manufactured is a driverless car which has been manufactured for the first time, in which case there is no past data for the entity or the industry, and we don't know how much claims can potentially mount up, and hence in such cases, even if I've sold the cars, I don't know how much will be the expenses that will be incurred. So we will give a disclosure in the notes to the extent that there is a present obligation which is arising because I've sold the goods and hence I'm under an obligation to repair. So there is a warranty obligation. However, I'm unable to measure it, and hence I will have to, in extremely rare cases, we will have to give a disclosure for the same in the notes about our inability to measure. Again, provisions are liabilities, and hence they should be remeasured at each balance sheet date to reflect the current best estimates. It is not that it is equity in nature and hence once determined it cannot be remeasured. No, provisions have to be remeasured at each balance sheet date to reflect the current best estimates. If you had recognized the provision at present value basis, like site restoration provision, you will then have to unwind this provision over the period of time, and the unwinding amount is to be taken in the P&L in the form of finance cost. Then there are two important special cases in this contract. One, there is something called as onerous contract. Onerous contract is like a burdensome contract, which is a contract where there is an unavoidable loss. So you are under a contract where the cost of fulfilling the contract or cancelling the contract is greater than the benefits that you will get from executing the contract. So, like for example, in your CA Inter, in AS7, in construction contracts, it was possible that you took a contract whose construction cost estimated was 1000 crores and the revenue was only 800 crores. AS7, in your Inter CA, I told you to create a provision for expected losses of 200 crores. These are losses which are arising out of a contract, which has become onerous or burdensome because the cost of fulfilling the contract, that is 1000 crores, is greater than the benefits or revenues that are arising out of the contract, that is, let us say, 800 crores, and hence 200 crores over here refers to the onerous or burdensome element for which a provision has to be created. So how do you figure out whether the contract is onerous or burdensome, and how do you measure that loss? So the standard says the contract, the measurement of the amount of the onerous contract, that is, you will have to create a provision for loss immediately on the onerous contract to the extent of an amount which is lower of the net cost that you will incur if you were to fulfill the contract or cost if you were to cancel the contract. Like for example, we have taken a property on rent for a period of 11 months, loosely speaking, and in which case it's a short-term lease and we have to pay, let us say, 11,000 rupees in the form of lease rent over the period of 11 months, that is 1000 per month. Now the business in which you are operating has been banned and you can't operate that for the next 11 months, but it's a non-cancelable lease, so we'll have to pay 11,000 rupees. At max, what you can do is you can sublet it, and if you sublet it, you will get 5,000, which means 6,000 over here is the unavoidable loss which you will incur if you were to fulfill the contract. An alternative is you can go to the lessor and request a cancellation, where the lessor might charge you a penalty of, let us say, 4,000 or 8,000, let us say. In which case, over here, if the lessor charges a penalty of 8,000, you will say, chalo, theek, I will continue with the contract and I will sublet it. I will pay 11,000 and I will earn 5,000. 6,000 is my unavoidable loss. Or if the penalty is 4,000, rather than continuing the contract, I will cancel it. In which case, rather than paying 11,000 and earning a subletting income of, let us say, 5,000, I will might as well cancel it and pay 4,000 rupees. Obviously, if required, time value adjustments will be done, but just at an overall principle level, the unavoidable loss is the lower of the two. So when you look at an onerous contract, it is a contract where the unavoidable loss, there is an unavoidable loss, whether you fulfill the contract or you cancel the contract. In such cases, you will have to create a provision for the loss on the onerous contract immediately. You will not wait till the time the loss actually will happen. You will create a provision for the same immediately. Remember, you need to distinguish between the losses that arise out of an onerous contract against the losses which arise, which are regular future operating losses. Like, for example, if you start a startup and you are prepared to bear 3 years of losses, these are expected future operating losses. They are not arising out of a particular contract, and hence you do not create a provision for the same right now. The standard believes that if you start a startup, but then it is very much possible midway you decide you don't want to continue it, and hence you are under no obligation to pay that amount which you expected as future operating losses. However, if you have executed a contract, then you have no realistic alternative but to settle on that, and hence few expected future operating losses are not treated to be a part of onerous contracts. Again, the standard gives you additional guidance that if a contract turns onerous, then the assets that were used to fulfill the contract, there is an indicator of impairment on these assets, and hence you should do impairment testing if required. So this is about onerous or burdensome contract. And the last special case which I would rate as important, or rather very important in this chapter, I would rate the accounting for contingent assets and contingent liabilities, and this part, that is provision for restructuring, to be the most important parts of this standard. So when we look at a provision for restructuring, what do we mean by restructuring? Restructuring refers to changes like closure of a particular business or a geography or a line of activity, major changes in the management or organizational structure, etc. These are termed to be restructuring. So what do you do? Well, should we create a provision for restructuring? The standard gives you guidance over here for two specific aspects. It says, first, it gives you guidance on the timing. When should you create a provision for restructuring? Second, it gives you guidance on the amount. But for what amount should you create a provision for restructuring? First is the timing. You should create a provision for restructuring when there is a legal obligation to restructure. Like, for example, TikTok gets banned and TikTok is told to kind of close operations in a geography within 90 days. In which case, the obligation to close arises the moment the legal order was given, and hence there is a legal obligation to restructure the moment the order was given. You don't have to wait for 90 days. You can create a provision for restructuring the moment the order is given. Or there's a constructive obligation. Now, the constructive obligation typically arises out of past practices or published policies, which gives rise to expectations. However, for restructurings and closures, we don't usually have a past practice or a published policy, and hence some alternative guidance is needed. That is, we will say that we will assume that the constructive obligation to restructure arises if there's a detailed formal plan which is in place and which has been approved, and on account of the detailed formal plan, we have identified the assets, employees, customers, everything who gets affected. So one, there needs to be a detailed formal plan in place, and second, that plan has to be either communicated to the affected parties or the implementation of that plan should have started. If either of these two have happened, then it kind of is considered to give rise to expectations in the minds of the affected parties. The existence of a detailed formal plan in place which gives rise to expectations in the minds of the affected parties, and that can arise if the plan has been communicated or the dismantling process has started or implementation of the restructuring has started, in which case we are allowed to create, or we should create, a provision for restructuring. But at what amount should you create a provision for restructuring? Well, the standard says that we will include directly attributable cost to restructuring, that is legal cost, bankers' fees, or termination expenses linked to employees whose employment is getting terminated. Now, what will not be included in the provision for restructuring? Costs which may be relocation costs, or costs which may be incurred to set up new infrastructure or new distribution networks at the new place that you are shifting, etc. These will not be included. Now one can always say that you are relocating employees, that is because of the closure that is happening over here, but the standard believes that restructuring cost ka provision will be costs which are directly linked to closure. Relocation is linked to continuing operations and not to closure. Termination cost is linked to closure, and hence we will include the termination cost that is to be paid to the employees as a part of our provision for restructuring, but relocation cost we will record as and when the relocation happens. We will not take it as a part of the provision for restructuring. Similarly, other items like expected future operating losses because of the restructuring, well, they will be recorded as and when the losses are going to happen. We will not create the provision for restructuring for expected future operating losses. So this is the general guidance for restructuring provisions. And the last special appendix that you have is regarding levies. So certain companies like electricity companies, they have to pay certain levies, let us say linked to turnover, in which case the standard says that you will create a provision or a payable on account of these levies the moment the specific threshold is crossed. So the moment the threshold is crossed, let's say it's a revenue-based threshold, then after that threshold is crossed, you will create a provision or a payable on the account of these levies. So I guess that should be it. I hope this video has been helpful for you. Please do like, share and subscribe, and let us know in case you need any other videos or content where we can potentially be of help. Till that time, wish you all the very best, study hard, good luck, and I'll see you soon with another interesting video. Goodbye, take care.